The same developments that led to the housing crash in 2008 is currently happening today. In fact, this has only happened twice before in history, at least over the past 50 years, at least since 1968. Mortgage rates have hit 7% again today, putting them at a higher level than they were back in 2007 in the lead up towards the housing crash of 2008. Back then, mortgage rates hit 6.7% twice, but the consumer was not able to withstand these higher rates, causing a rapid collapse in home sales back in 2006 and 2007, which eventually led to a steep decline in home prices throughout 2008 all the way until 2011. All of these developments, of course, led to a steep contraction in economic activity and a severe recession. Now, as mortgage rates are hitting 7% again today, while home sales have been plummeting throughout the last year and a half, this is a setup that you could say is reminiscent of the lead up to the massive top in home prices back in 2008, and also something we saw back in 1980. So in this video, I am going to show you why we are likely on the edge of a decline in home prices, how that's going to impact consumer confidence, consumer spending, and ultimately drag the US economy into a recession. We're also going to take a look at when we could see a turnaround and a bottom in the housing market. Now, without further ado, let's get right into it. We run a trading and investment service at gameoftrades.net. We have a model portfolio where we include all the investment ideas that we have that we find have a great risk reward right now from a macro standpoint. For example, we added Turkish stocks a few weeks ago. They're up around 12% since we added them, significantly outperforming the S&P 500. These are very cheap stocks that are uncorrelated to the S&P 500 that we actually find is very risky right now and has a lot of potential runway here. That's one of the key missions we have at gameoftrades.net, is to provide you with these types of high quality investment ideas, maximizing your potential reward on these trades, taking you through them step by step. We are doing a 20% discount on all our memberships today. So if you are interested in this type of service, make sure to grab yourself that deal. Now back to the video, let's take a look at the impact of mortgage rates on the housing market, because there's almost a perfect relationship between higher mortgage rates and a weaker housing market. You can see that on this chart here that shows mortgage rates against existing home sales. Now, of course, home sales on this chart are reversed. So you can see as mortgage rates are rising on a year-over-year basis, you typically see a contraction in home sales, something, for example, we saw throughout 2022. And mortgage rates actually lead home sales by around 3 months. The orange line here is shifted forward by 3 months. So the rise in mortgage rates that we've seen more recently, with mortgage rates hitting 7% again, is going to put further pressure on home sales. Now, of course, this is a year-over-year chart, so it looks like things are improving a little bit. We're not at the same level of contraction that we were at back in 2022, but the fact that we're still well above the zero line means we're still in the period where the housing market is deteriorating, not improving, for example, like it was after the pandemic in 2020 and 2021. So this decline in home sales that we talked about at the beginning of the video that started towards the beginning of 2022 is probably not recovering just yet. Some people were suggesting that with the recent bounce in home sales, but as mortgage rates are staying elevated, that's likely to put further pressure on existing home sales, like in the 2006 and 2007 period. Part of the reason for that is also because people don't feel like buying homes. If you look at this housing survey for buying conditions, they're at the lowest level we've seen since 1960, explaining why these higher interest rates are impacting home sales. Now, if we zoom out on a longer term chart and we look at existing home sales against home prices, and these are home prices on an inflation adjusted basis, you can see declines in existing home sales lead home prices. This is what we were talking about at the beginning of the video. In 2008, existing home sales were trending violently lower for almost 2 years before home prices really began to turn down. And we actually saw the exact same thing happen in 1980 here. Existing home sales peaking in around 1979 and beginning to move aggressively lower. That led to a sustained period of home price underperformance, home price stagnation between 1980 and 1984. And what you typically see is that home prices don't bottom until you see a substantial recovery in existing home sales. When you actually start to see people buy homes once again, that's when you can potentially start to see a bottom form in home prices. That's also what happened in 2011 here. You had home sales start to rise significantly here in 2010, 2011, which created a bottom in home prices in 2012. We're going to come back to that in just a second. Now, of course, keep in mind, this is on an inflation-adjusted basis. So if you look at home prices, nominally, they were just rising throughout that period. But when you take into account the actual cost of living throughout these periods, home prices were going down. Now, why is this important? Because most people see the value of their homes as their greatest asset, the largest portion of their wealth. And so when the value of your home cannot keep up with the rate of inflation, like in the early 80s, and also, of course, like in 2009, that can lead to a decline in consumer confidence. Now, today, you can see we haven't seen a collapse in consumer confidence yet. Some measures of consumer confidence, like the Michigan Consumer Confidence Survey, does show that consumer confidence is depressed. But when you look at the Conference Board consumer confidence, it's still at very high levels, not levels typically seen during real economic downturns. And it makes sense that people are still quite confident. The value of their homes is substantially higher than it was just a decade ago, even on an inflation-adjusted basis. And the labor market is very strong. The unemployment rate is at the lowest level since the 1960s. So why would people not be confident if they have a stable job and an expensive home? Now, again, you could say this is something we saw back in May of 2007, where you had home prices at decade highs and you still had the unemployment rate that was still very low. So a very strong and stable job market back in 2007. And so consumer confidence was quite high, around the same levels as we are now, with a strong housing market, a strong labor market. But keep in mind, this was happening as we had a substantial decline in home sales that was signaling you were going to see a lot of weakness in home prices. Very similar, perhaps to a lesser extent than in 2007, but still quite similar to 2022, where you have had a similar type of decline in existing home sales that could ultimately feed into a decline in home prices on an inflation-adjusted basis, just like it did back in 2008 and like it did in 1980. And that's what can finally trigger a collapse in consumer confidence, like it did back in 2008 and like it did back in 1980 right here, where consumer confidence was moving lower as home prices were declining and the job market was weakening. So what we're seeing today with mortgage rates hitting 7% again, the housing market clearly being sensitive to these rising rates and already having shown a lot of weakness over the past couple of years, does increase the odds that we're going to be seeing a decline in the value of homes over the next couple of years, and therefore a decline in consumer confidence, which ultimately can trigger recessions like it did in 2008, 2009, and like it did in the 1980s. You can see existing home sales decline leading into recessions. And the bottom in existing home sales typically happens during the recession. And of course, because of the sheer power of the housing market, this also impacts corporate earnings. Existing home sales is the best predictor of S&P 500 earnings 10 months out. So rising mortgage rates and declining existing home sales could put some pressure on S&P 500 corporate earnings. And as we've discussed over the past couple of videos, analysts are forecasting very strong earnings for the next 6 months, which could leave the stock market vulnerable to some disappointment on the earnings front. Now, of course, there's always a light at the end of the tunnel, and we know exactly what needs to happen in order for the housing market to recover and for there to be a more optimistic economic outlook. And one of those things is the Fed needs to cut rates. Every single time that the Fed cuts interest rates, you tend to see mortgage rates decline and you see a recovery in existing home sales. That happened in the 1970s. The Fed cut rates violently in 1983, leading to a substantial recovery in the housing market in the 1980s. Even in 2009, once the Fed began to cut rates more aggressively, you quickly saw a bottom in existing home sales and eventually a recovery and a bull market in housing between 2010 and 2021. So it's not all doom and gloom, and we're not heading towards the end of the world. We are just at the part of the economic cycle where the economy is vulnerable to seeing some pullbacks in various areas. And indicators like existing home sales are telling us that we are seeing those dynamics playing out as we would expect, that the economy is sensitive to the tightening of economic conditions we've seen over the last couple of years.